What's going on out there? It's October 25th. I'm Frank Curzio, the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. So fresh back from Las Vegas, celebrate my wife's 50th birthday. Had a great time, and holy cow, it was crowded as hell. But I took her to go see a Katy Perry concert. Had some great seats, which was awesome. She's an unbelievable entertainer. Outside of me and my wife, I think the rest of the entire audience, we're talking about thousands of people, were gay, I think. But I don't think I know. But I guess she's really big with the gay community. I had no idea. But the place was rocking. It was absolutely rocking. Everyone was just having a great time. She was, again, just a great entertainer. She was funny. She had a dance-off contest and offered free pizza to the winner and pulled two people up from the crowd. There was a young girl who was 8 years old, probably the youngest person in the whole crowd, that was sitting in the row ahead of me, which is the first row. We had second row seats. And Katy Perry came over right to her and said, hey, it was talking to her, like right behind her. So it was almost like she was talking to us. It was really good. She was just funny. The pizza, she took a slice of pepperoni pizza, threw it into the crowd, probably hit somebody. She said, I got one show left. It doesn't matter. It was entertaining. She sang all the great songs, a lot of fun. And then, we did a few other things. I told you guys, two things I didn't want to give away. That was one of them. The other is we went to, I took her to a place called Dig. And if you want to do something original when you're in Vegas, this is definitely it. We got to drive 6-ton excavators. And we're actually driving these things where we were in our own trucks with headsets, and the instructor is basically on this, steel metal ladder and guiding you, and, we're next to each other, just swinging that massive, just pile that just digs into dirt. And it was unbelievable. I mean, these machines are incredibly powerful, incredibly. So you do everything yourself. I mean, you dig these massive holes, picking up tires, building pyramids, going through an obstacle course, and it was fantastic. It was original. It was experience. It was funny when we first got there. My wife's face, she was like, what the F are we doing? What is this? And afterwards, I said, just give it a try. I heard great reviews. And I think every single review, like over 5,000, were fantastic. Afterwards, she loved it. But this is about a 10, 15 minute ride from the strip, not too far. They have a massive facility with all these huge pickup trucks, excavators, bulldozers. The ones you see in major construction sites, you could take out different things. You could, destroy cars if you want. We did like the obstacle course one, and I mean, it's really serious. And they actually certify people to work in the field. And, my wife and I, we could actually operate these things. Like if we had to operate them, we know what to do. That's how much they show you and teach you. And, but if you're in Vegas, looking for something original to do, this is it. These are those big construction trucks that you see in all these, major construction sites. It was fantastic, but we had a really good time. Did not win gambling. We got crushed the first couple days, did okay the last day, but holy cow, it was surprisingly, like I go to Vegas a lot, probably 3-4 times a year. It was jammed. It was pre-COVID levels. Prices through the roof like you cannot believe. And sodas at casinos were, just for a cup was $6, slice of pizza was $9, to where I said, how much is the pie? And it was like $42, $43. I said, just give me a pie. And it was just like this big pie, right? We had to walk to our room, my wife and I, with it. And this is like 1:30 in the morning, and they don't have a lot of places to eat. And our hotel was hooked up to another major hotel. We stayed at Palazzo, and it was hooked up to the Venetian. So they had the food in the Venetian. So I'm walking with this pie, and I felt like I was a one Chippendale at the strip club with 1,000 girls there. I mean, everybody was like, where'd you get that? Oh my God. It's like, a bunch of drunk people. Everyone's looking for food. And it's not easy to find food that late in the casinos, right? There's only a couple places open. And we had this big pie of pizza, and it was like we were rock stars just walking through, because we had to walk through the whole Venetian casino, then a Palazzo casino to get to our hotel, which is, literally thousands of people. It was so funny how many people stopped us. Where'd you get that? Oh my God, that's great. It was just so funny. But we also went downtown to Fremont Street, which is, crazy area. And they had several live concerts. They had a big festival going on. And one of the places was at Fremont where they had Slaughter was performing, which, we didn't even know. My wife actually likes them a lot. She was like a rockhead when she was younger with the 80s hair and stuff. And, Skid Row, Def Leppard, Poison, Police type person. So she was like, oh my God. So that was, I told her I'd plan the whole thing, and I didn't. We got lucky that they performed and got to see them up close. I took videos of this. There were thousands of people in the street everywhere. Right? This is a free concert everywhere. You could barely walk. And these are off-strip casinos. which were packed with people. I mean, the strip ones, not so much when it came to gambling and the casino floors, but the ones on Fremont and off strip, they were packed, absolutely packed. Slot machines packed, tables were packed. It was just, you couldn't even get a girl to get you beers or anything. It was insane. It was so packed down there. But Vegas is rocking. Now, I know MGM, Las Vegas Sands, Wynn have exposure to Macau, especially Las Vegas Sands and Wynn, who are all in on Macau and China, and the zero COVID policy is hurting them tremendously. I think it's going to continue. But the casinos with no Asian exposure, especially with China exposure, Red Rock, several others I won't give away since I may be recommending one of these in tomorrow's Curzio Venture Opportunity newsletter. In fact, we have Red Rock resorts in the portfolio already. It's up about 150% for us, 140, 150% for us. And that's like a 2-year hold. We bought that right after everything started opening up in COVID, when we sold everything just to avoid the crash in COVID. That was one of the names we bought early on. I think it was in June and July 2020. And we did unbelievably in that name. And I still think it's going to go much, much higher. I mean, these casinos outside of the strip were just completely jammed. I couldn't believe it. Again, they had a big music festival there. The Raiders were playing at home. So Uber drivers, even when we went to the airport, I mean, they jacked up prices incredibly, probably double. From someone that goes to Vegas a lot, I couldn't believe how busy it was everywhere. I was talking and we took probably about 5 or 6 Ubers to different places, and asked them how business was. Everyone said it was booming. It was great. I asked a couple that said, definitely back before, pre-COVID levels. That's how busy it is. But for me, I couldn't believe how busy it was everywhere. It just shows that, in some places, people are going to travel. They want to spend money. There's still money out there. But it was a crazy trip. It surprised me how busy it was. And my wife had a great time for her 50th, even though she hates saying that. Yeah, when I say it's her 50th, I'm trying to say it's her 34th. It's a big birthday. That's what we say. It's a big birthday. But we had a great time. Just got away. It was really, really cool. And official birthday was yesterday, which we celebrating. Had a cake and everything with the kids and stuff and my family. But it was a really, really good time. A nice time away. But man, it was booming. But when I look at the markets and get into the markets earnings, we've seen pretty strong earnings. If you watching TV and listen to them, earnings are strong and the market's going higher. 3MG did cut estimates, so did JetBlue, but we are seeing some strong earnings in other areas. GM reported very strong results, but kind of like these companies that even reported good results, they're not raising guidance. I mean, you got to be a little crazy to raise guidance. Maybe some are a little bit. Just there's so much confusion going forward. Is the economy good? Well, I went to Vegas, and economy you would think is unbelievably great, and you go other places, and it's absolutely terrible. You look at the housing market in Florida and Texas still holding up. Most states are not. You're seeing prices collapse. You're seeing a lot of building projects get canceled. I'm starting to finally hear from vendors that have told me, listen to this podcast, that things have been absolutely booming, not seeing it. They're starting to see it. They're starting to see it and starting to prepare now. I mean, again, there's pockets that are doing well still, but other places where, where you're going to see houses. Like that's a major driver of the economy. And we're looking at 7.2% mortgage rates. And you look at double the payments that you had only a year ago, which a lot of people can't afford. And that's why you're seeing a collapse in the housing market. Right? Again, big driver of the economy. GM reported those decent results. That's one of the names we have in our Curzio Research Advisory. I just think they're much, much better position. I think we're flat in the position right now, around flat. We just recommended it like a month or two ago. Much better position than Ford, a lot of the other OEM competitors in terms of balance sheet, EV investments and technology, outside of Tesla, which is, 100% EVs. They're rolling out their EV vehicles much faster than, again, you're looking at the GMs, the Hondas, the Fiats, everybody who says that they have, all these EV companies that use all these EV products, right? And cars that you see on TV, they advertise the shit out of this, right? Everywhere. You see EVs, they're not available yet. They're not going to be available. You can't even buy them within a year. Rivian, all these companies. They're everywhere. That's all they do is advertise. They're advertising a product that looks awesome that you cannot buy, that you can't get. And it's going to be interesting. I think people who are familiar with this trend and you're going to buy an EV, that's fine. I think a lot of people are more optimistic on this market than ever. And you're going to see people think about it, if you go out with your friends and you're hanging out and you drive them someplace and you drive them 3 hours away, that's fine. You might get away with one charge, but then you're like, oh, I'll be back in 40 minutes. I got to go charge my car. Compared to 1 minute and go into a gas station, which is a half a mile away, there's not everyone that's going to adopt to this. I mean, you could force it and mandate it like they're doing in California, and by 2030, everyone, no matter what, you have to, right? Which is crazy. especially since they have grid problems. And if that doesn't turn on, then I guess you're not driving anywhere. And hopefully nobody has a heart attack, has to go to the hospital, because everything's going to be EV vehicles. I don't know if they have bicycles and going to be driving people while they're having heart attacks at hospitals. Who knows? But it's just interesting. With GM, I think they're much, much better position. But again, it's a tough economy. They're seeing supply chains ease. I just like the quarter overall. They didn't raise guidance, which is smart. So, I do think when I look at the rest of the industry that this one's going to do much better, even though I think, the markets could head, gradually lower, especially over the next year. I'll talk about that in a minute. But overall, we're seeing a strong rally, right? And a couple of weeks ago, I'm like, we got to watch out. There's going to be a market crash. It's going to be crazy. And what happens is you're seeing stronger than expected earnings, where over 70% of companies have beat estimates. Those are all facts. Those are facts. I covered this because this is why I love data. You can look at things and say these are facts, but it's how you interpret them. You can interpret that 70% of companies have beat estimates over 70%, and you'd be right. You're not lying. But keep in mind, these estimates have been revised significantly lower into the quarter. For example, when we look at the actual numbers, and that's what I like to do, and I like to dig in. I'm not pouring cold water over all this. I said, I hope I'm wrong in this prediction that stocks are overvalued, that they're going to come down. This is a bear market rally. We're going to see a few of these, right? I'd like to see stocks go incredibly high. Most of you are long. I have even long positions, but I'm protecting myself, and I showed you how to do it by buying long-dated puts. And not just protecting, but making a lot of money off of that. And I think right now, this market rally, it's one of the greatest times ever to really put in the strategy. And they had great pricing now that a couple of these stocks and a couple of names have gone, just higher with the overall market, right? But let's dig into this data a little bit. For example, when we look at the actual numbers, only 26% of companies reported thus far. That's 26% of the companies in S&P 500. And when you look at these 26% of companies, and you can say, well, 70% of them have beat estimates, you're right. But if you take the actual number, earnings from those companies were up 3% year over year, only 3%. That's an incredibly, incredibly slow growth rate for a market that's trading at 70 times forward earnings. That's what we're trading. And when I'm saying 70 times forward earnings, I'm taking like a number that's 6 months away, right? So I'm not even taking like the much, much higher earnings number, which I have no idea how we're going to get to without the Fed help, right? That's how we got to 2019. I told you the number that we peaked at. I keep saying this number, which is scary. We peaked in 2019 at 159. If you want to go on our YouTube channel, I'll show you the chart and all my figures and stuff. So we peaked at 159 in 2019, because 2018, we were at $160 in total earnings for the S&P 500, right? That's what you do when you do. You figure out the PE ratio of the S&P 500, you do price divided by earnings. That's the earnings number they take, the full earnings number of all the companies. 2018 is 160, 2019 is 159. And then we had COVID, but then we had trillions, 11 trillion injected to this market, massive quantitative easing, right? Fed buying bonds. And 2021 went over $200 in earnings. In 2022, we're expected, $226 in earnings, right? So we're not finished with 2022 yet. And then in 2023, we're expected, this is the expectations, $244 in earnings. In 2024, it's $260 in earnings. These two numbers right here, which is insane. How are we going to get to those numbers when in 2019, we couldn't come close to those numbers when we, again, we had zero interest rates. We were trading at 25 times forward earnings back then. And then we had COVID 2020. But how do we get to 244 with the Fed removing the 11 trillion from the market and rates going to be probably over 5%? We could talk about that too. I mean, it's insane to think that earnings are going to be this strong. I don't know how they're even going to get to $200. And again, companies are doing their job. This is what they do, right? So they go into earnings and they predict, how much earnings are going to be. And they have these expectations from analysts and they try to meet these expectations. But when you really look at the numbers, guys, and you look at what they're doing, they're actually cutting costs dramatically. And at this level, it is kind of scary. It's scary to see how they're going to continue this. And even right now, you can say, well, earnings are much better than expected. They are, but they've been revised lower. We're going to show probably no growth. We showed no growth year over year. I don't know how we're going to show growth in we're expected 7-8% returns next year. You can see they're only 3% right now, right? You wouldn't know that. You would think they're much higher than that because everybody's beating estimates that analysts actually lowered. So, if you look back 3 months ago, this is exactly what happened with the markets, where stocks fell sharply heading into the quarter, then rose more than 10% during the quarter, and media and analysts, they all came out reports. Earnings per share are still strong despite the Fed raising rates. Our economy is resilient. It's working. The Fed's able to raise rates, and the economy is not getting crushed. That's what they said last time. And then what happened? Stocks fell 16% shortly after, probably within 6-7 weeks after. I'm not sure how we won't see this same trend. With the Fed looking to raise rates considerably from here. 75 basis point hike in November. I think it's on November 2nd, which brings short-term rates to what, 4%. But most are expecting another 75 basis point hike in December. Now, rumors had it, which is the Wall Street Journal, so a lot gets leaked to the Wall Street Journal just before, right? That's what, everybody does within the government. And rumors have it the Fed may talk about slowing down. My question is, how the hell can they? UPS reported, and you saw FedEx, which was a disaster and removed guys, but US was strong. They beat earnings per share, not sales, they beat earnings per share. And the earnings per share beat was based almost solely on rising prices. And they said, well, we're seeing demand, but they raised prices considerably, and people paid them for now. Coke said the same, seeing solid demand, but yes, we raised prices. So did Pepsi, raise prices. So what do we have here? We have energy prices rising again. This month they're rising, right? We're going to see a huge jump in CPI. We have food prices rising again. We're seeing it. We're seeing it across the board with food companies that are reporting they're raising prices. You're looking at rental properties and rents not going down anytime soon, which we know, right? That's 55% of the CPI. So we're going to see the October CPI get reported in 2-3 weeks. It's likely going to rise month over month, which is insane. And we're going to show that the core CPI, which is what they look at, right, excludes food and energy, has still not peaked. It's not like it's peaked and we're seeing it come down slower and slower and slower. It hasn't peaked yet. So how can the Fed slow with these rate hikes or say, hey, we're going to stop raising rates, especially as this is going on? And now with the market starting to get a little bit of a bid here and people say, well, it's going to continue for the fourth quarter. If it is, we're probably going to see even more of a collapse when it comes to first quarter. I think it's going to happen even in December. I mean, or after this earnings season, we might see a little bit of a pop when, stocks usually do well when you have a split government, and it looks like the Republicans are going to take back not just the House, which is expected, but also the Senate right now based on the polls, which, we saw what the polls were last time, so who could believe them, right? I think they had Trump losing, Ohio by 12 or 15 points, and he won. I mean, some of these polls were insane, but right now that's the expectations. Even the biased polls and Democratic polls have the Republicans really starting to surge right now. So that could be a little bit of a catalyst, and that's election in, early first week of November. But other than that, when earnings are over, again, these estimates keep getting revised lower and lower and lower, and that's what you're going to see. And yes, it's easy to beat them, and you can say, wow, things are good, but you're looking at the 10 years still over 4%. You're looking at the 2 year at 4.4%. You're looking at mortgage rates over 7%. The dollar has retreated a little bit, which is why you're seeing a little bit of a rally. But how could that continue? I mean, I talked about plenty of disinflation areas of the market. And I said, well, the Fed would have to. I never thought the Fed would be going over 4%. They're going to be over 5% next year. And for most of the year. I mean, forget 4%. It's going to be 5% now. And that's why I changed my tune. I'm like, wow, the Fed is really looking at the two gauges that they only care about unemployment, and that's staying artificially low. And you have the CPI, which is going to, it's not going to moderate anytime soon. I mean, you really think we're going to get down to 2%? Even if they change it, which they're going to change, right? They always change, and revise and say, well, it's probably going to be more like 3.5%. We're not going to 3.5% next year unless you raise rates considerably. And that's what they're going to continue to do because that's the gauge that they look at. But disinflation, you look at housing, right? Not rentals have come down. Commodities are like copper and lumber. Lumber prices are up 25% this month. Copper prices are up in October. Soybean, canola, a lot of these big price inputs into food now rising again. Sure, you have PCs, technology price coming down as we have supply gluts. Same with cars. But Apple stopped production on iPhone 14s because it's seeing slow in demand. And even that's catching a bid here, which is surprising. But the gauge the Fed looks at is the CPI. And it's still going higher. So the price is going higher and the market's rallying here. I'm going to ask the question. How can the Fed stop raising rates? What makes you think they're going to stop raising rates? How can they? They're going to stop raising rates with the CPI at 7-8% and staying there? I mean, the market's rebound and gives them a little help because people, the market, you say, well, it's supposed to be different from the Fed, but it's sentiment, right? When the markets go high, people are going to be happy. They have more money, they're happy, they're going to spend more, right? They saw that house price come down considerably in most areas, and it's still coming down. It's going to come down sharply more. And the markets have come back a little bit, but even with the markets coming back, you're going to see sentiment, maybe gain a little bit, get a little bit stronger, but it's given the green light for the Fed to continue this policy. And that's what's scary because they already overshot. They clearly overshot. They just don't have the patience to wait this out. I mean, they thought like inflation was transitory, that everything they've learned for 40 years. It was transitory for 20 years, right? All of a sudden, in the blink of an eye, they switch. It's never going to be transitory. We got to keep raising, right? It's just a big flip-flop. That's why I said that most of these guys should be fired. They're not qualified to run in this type of market or run the Fed in this type of market. If you thought it was transitory at 5%, it went to 9%, and now all of a sudden it's not going to be transitory at all. It's after you raise rates considerably from basically 0 to 4.5% by the end of this year, at least, you got to figure that you're going to see a much, much quicker slowdown, but they're not anticipating that. They're like, no, forget it. So it is interesting. It's a tough market. 3 months ago, a 4% Fed fund rate forecast for all of 2023 was absolutely insane. Will likely be over 5% for much of next year. And I can't see how that's not going to result in a collapse in asset prices across the board, especially equities. I mean, you have no Fed help. They're not going to be buying bonds, injecting money directly into the economy, which we call QE. Mortgage rates well over 7%. You've seen that collapse in the housing market outside of a few states, which is a massive, massive driver of the economy. Look at Europe, look at China, look at Japan, and then look at most emerging markets are getting wrecked, which means as rates go higher, they're going to get wrecked even further because they're filled with debt. And what are they going to do? They're going to buy the dollar. It's going to push the dollar higher, which remains near 12-year high against most currencies. It has come down, which is leading to this rally. But how do we see the dollar continue to come down when we're raising rates and the global economy is getting wrecked? They're going to be buying the dollar. So the 2 years, over 4%, 10-year, over 4%, 2 years over 4.4%. I mean, so even the 2 year over 4.4%, that's risk-free. That's a risk-free rate. And if you compare that to the S&P 500, which pays a 1.8% yield, which one would you rather buy right now? Because you got one that's risk-free, guaranteed, and on point, 4.4%, or, hey, you know what, the S&P, yeah, it's got a nice yield, but now you're taking on the risk of buying a super expensive index. It's extremely expensive based on how much earnings are growing. So when they say the multiple is around 17 times on average for the past 5 years, and over the past 10 years it's 15 times, that's based on zero interest rates, and that's based on more than 10% growth in earnings annually, year over year, which we saw a lot of those years. Now we have interest rates skyrocketing, which should bring that multiple down. And now you're looking at the growth in earnings at 3% year over year. We should be trading at a 10 multiple, 12 multiple tops. That's 16, 17 times. That's crazy. Do you want to buy the S&P 500 at those levels? An index not going to grow year over year, 2023 most likely at this level, paying a 1.8% yield, or let's just buy the 2 year. I don't know. I say buy the 2 year. Yes, you have to have exposure. Maybe the Fed just totally stops and says, okay, we're going to lower. Who knows? I mean, you have to have some long exposure, but you could see that when you're looking at 3, 6, 9 months, I mean, it's not pretty. It's not a pretty picture. The only way stocks continue moving higher for it is the Fed not just pauses on rate hikes, but anticipates or signals that it's going to start lowering. That's not till mid-2024, maybe. But we have inflation that's still surging. So I'm not sure how the Fed can slow the pace of rates anytime soon. It doesn't make sense. Which again is going to hurt the global economy, which many countries are already in a recession. Results in a higher dollar, which is terrible for our equities market, and especially gold. No more bond buying, QE from the Fed, but the opposite where they're removing money from the market. So that's a terrible market for risk assets. But enjoy the bear market rally. Companies doing everything they can to meet their revised, lowered estimates. Maybe they start buying back their stock soon, since they slowed considerably. They're drastically cutting costs, which doesn't mean, you would think like the economy is great if you're watching TV, but they're drastically cutting costs. They're closing factories, spending less on CapEx, cutting back marketing, laying off tons of employees across technology. I don't think you'll find a major technology company that hasn't laid off employees, while also considerably raising prices, which is unsustainable if you think about it. I mean, you're raising prices while not providing the same services, with fewer people helping you. You want proof? Try calling a customer service department today. You're going to be on for 45 minutes. Airlines, banks, retailers. Hey, what happened to India and stuff like that? Even they're too busy to answer your call. Restaurants are charging more than ever with prices going up. Their profit margins are surging, so they're not just like, oh, we have to charge higher prices because our import costs are higher. No, they're charging higher prices on top of the higher import prices, right? Input prices. And yet they have fewer employees and fewer items on the menu. You're seeing that across the board with so many restaurants, even fast food places. So how do you provide the same level of service? You can't, which is going to result in fewer customers. And then you have the Fed taking money out of the system when most people don't have the buying power they had a year ago when rates were super low. The home value was surging. They felt more confident, even with the markets at all-time highs. But now with rates surging and most people having debt across every country, including most consumers in America, their payments are much, much, much higher. Not just from rising rates, but also inflation. So something has to break. And we're seeing the cracks, right? Central banks flip-flopping in weeks between QE, quantitative easing, QT, quantitative tightening. In weeks, they're flip-flopping. Oh, shit. No, we can't. Oh, my God. Wait. We're raising rates. Oh, wait. We're going to buy bonds. Wait a minute. These are central banks. I mean, it's like Exxon buying a $10 billion facility in Saudi Arabia and then selling it a week later going, holy shit, we were wrong. You don't see stuff like that ever. But be very careful here. You don't have to sell everything. It's not what I'm saying. We're still long in our portfolios, but there's ways to protect yourself. Learn how to buy long-dated puts. Money flow trader that we talked about, which is selling like crazy right now. It was lowering the price by 80%. It's a 3-month membership. It's only $4.99. It's a $3,000 product. And I'm more happy than ever that people took us on. Again, it's a place where the greed factor, you could make an absolute fortune. If you really think of what I'm telling you over the next year, with the Fed no longer there to help you out, it's going to be a crazy volatile market, guys. I mean, the next 6-12 months, probably more volatile than any other time in the past 2 decades. And you're like, Frank, are you absolutely out of your mind? We had COVID. We never seen anything like in 2020. It was crazy. Then we had the credit crisis where the whole system almost got destroyed. Yeah, you're right. But you know what we did have? We had the Fed there to print hundreds of billions during the credit crisis and trillions during COVID. They were able to buy bonds. They were able to keep rates super, super, super low. That's gone. We don't have that anymore. We don't have the Fed there to the power to lower rates to zero like during those times. The Fed doesn't have the power to print money like it did during those times because we have massive, massive inflation. So it's not a buy the dip type of market. This is more like a 2000 to 2003 style market where, sure, the Fed lowered rates, which, again, we've never seen a market down over 20%, and the Fed's still aggressively raising rates. We haven't seen that. Usually they're supposed to be lowering as things get worse. They're not, because they can't, because it's the first time we had inflation in 40 years. But it's not a buy the dip type of market. It's been like for at least the last 12 years with rates near zero and unlimited QE from the Fed. And they can do whatever they want. It's a new market, guys. Get used to it. We said it in November as soon as they pivoted. Said it a year ago when they pivoted. This is different. This is a fundamental change in the market, and you have to be careful. This isn't like something, it's a typical, 3-month sell-off, and then we go in and buy, which, a lot of people are starting to do right now. It's worse than that. This is a market where you need to start listening to those old, boring value investors who have been wrong for so long because interest rates were zero and the Fed was cheating. It's basically providing a cheat code in a video game. That's why you're able to buy these freaking crazy SPACs coming out at 700,000 times freaking sales and the retail environment buying because everybody has money. That works. You don't have that anymore. That's big. It's like a company able to print trillions. If anything goes wrong, just suddenly went bankrupt and is not there anymore. Be careful. But listen to those boring value investors because numbers are going to matter. You're not going to see this runaway growth and buying these crazy multiple stocks anymore. And where's the growth going to come from? The 2 biggest sources over a decade have been the Fed and China, and both those growth catalysts will be non-existent at least through 2023 and likely well into 2024. So buckle up. Be selling stocks on rallies. Be careful in names you're buying when you're going long. Just so you can't go long anywhere. But if you're going to go long, look where the pockets of growth are, where it's energy, People still need to go on vacation. They need to go on vacation. They missed a lot of that during COVID. You're seeing that, which, again, in Vegas as well. So hotels, casinos should do well. I do like cruises, not Carnival. Since they're saddled with debt, they still didn't restructure like they had to. They cater to lower-income consumers who are really struggling right now. We have one name in our portfolio that's up 25-30% since recording 3 months ago. And it's cruise line. It's 40% cheaper to take your family on cruises than it is to take them to Disney right now. And this name restructured all of its debt. They have fixed rates, so they don't have to worry about rising rates, and they're going higher and higher. They finally have every boat in the water that's operational, which wasn't the case for a long time due to COVID, and they have no more COVID policy restrictions in place. So you see profits explode. I mean, look what you can get for your value, and a lot of these cruise lines are really cool when you go on with your family. I mean, there's some really nice places you can go and nice ships. And you can get like the all-exclusive package for what you're getting for average trip to Disney or average trips to other places. But find those pockets of names that got annihilated since March, have pricing power, which right now still happens to be quite a few companies. Names are not saddled with debt since payments are skyrocketing to higher rates. And names that can grow earnings outside of China. Now, tomorrow's Curzio Venture Opportunities, that newsletter comes out. I'm going to highlight a bunch of sectors and individual names to avoid, and even large caps, even though that's a venture newsletter. I'm going to share lots of names that you have to be careful of, the most exposure to China, as well as sectors to avoid, and also the sectors that you need to be in. I'm going to share at least one name, probably two. I'm not sure. Just doing a little more research on the second name. Looks promising, but again, just need to do a little bit more homework on it. But definitely one name. But I'll highlight all of these names for you in Curzio Venture. I'm not going to be giving away a lot of this free stuff, again, for a free podcast. I know you guys like to listen, but people pay for our services, and they get that value through the actual ideas. I'm going to recommend a lot of more ideas and stuff like that. Like I had a whole thing written up of 20 different ideas and sectors and stuff like that to avoid, and different names and stuff like that. We're going to keep them within these newsletters that people are paying for. I mean, that's incredibly valuable, especially in this market. But just be careful here. And you're probably getting excited. Hey, the worst is over. We're starting to rebound. Stocks are rallying. The Fed may pause. At least that's a sentiment out there. But the Fed is not going to pause. They haven't given any signal that they're going to pause. Even if they do it 4.5%, which would be 75 basis point, which is guaranteed on November 2nd, and then a 50 basis point hike, which we're pricing a 75 basis point hike for December. But they stop at 4.5%, which is lower than the market is pricing in right now. People are not going to go out and start buying houses with 7% mortgage rates. The Fed's not going to suddenly start buying bonds again, QE. And you see in stocks, these types of moves where everything is going higher at the same time. It's the blueprint. It happens all the time in bear markets. So right now, it's not the time to be super aggressive. It's a time to be smart. That greed inside you should be, it's inside your head. It shouldn't come from, I want to go long aggressive stocks here. It should be from, let me buy puts. Because a lot of these companies are going to get wrecked going forward. But don't be afraid to take some off the table, especially during these market rallies, since you want to have as much money as possible. Since asset prices, you're looking at homes, many stocks, collectibles, you're going to get a chance to buy most of these assets much, much cheaper in the future. And when you're buying stuff at super cheap prices, you can do it with some stocks here, but when you're going to do it with homes, you're going to do it with a lot of assets, collectibles coming down sharply from here. Even NFTs have come down sharply from here. That's how you create generational wealth. You welcome these types of crazy markets, and it's going to be crazy for a while. So buckle up, be careful, protect yourself, and if you're long, be long in the right industries. Those industries you'll learn from all of our products, all of our newsletters. Questions, comments, I'm here for you. FrankKurzioResearch.com. Really appreciate all the support. I'll see you guys tomorrow with the one and only Daniel Creech. Take care.